Okay, what is up, traders? What's up, tycoons? Super excited for today's video. And unfortunately, you all have been lied to. Okay, everyone on YouTube for the past year has been telling you guys that TLT has hit the bottom and is going to go higher, and they're not really giving you any evidence to support that. Now, unfortunately, in my opinion, you guys know I do think TLT is going to go lower, and we're going to cover that in today's video. Now, a net $1.76 trillion plus of treasuries has been issued this year. Janet Yellen has been flooding the treasury market, and that is going to cause yields to go higher and bond prices to go lower. It's just that simple. And they've got another $1 trillion that they're supposed to issue by the end of the year. Okay, so we're going to break down a lot of that data and show you guys the evidence behind that data. All right, and US treasuries are now more volatile than gold. We'll speak about that. And then we're going to cover the TNX chart. This is your 10-year treasury yield and where it can potentially go, why I think it's going to 5% plus. And then we'll break down the TLT daily chart. These two are going to move a little bit inverse of each other. And so once you understand the analysis, you'll see why I think it's possible TLT can come down to the $80 range. Now, these are all just targets and guidelines. It's not things to live or die by, but things have been following the analysis pretty well, and we'll have to see how they play out ultimately. Now, Americans age 65 and up, there's some important demographics here that we're going to cover. We're also going to cover financial conditions. We're going to talk about the average performance of oil over conflicts, okay, around these major Israel and Palestine conflicts. These are things that are important, especially if you're playing energy. We'll talk about the correlation between oil prices and bond yields. And then we're going to take a look at some positioning in the market, right? So we have the aggregate positioning, we have positioning declining. We have CTAs being short a massive position, but asset managers and leveraged funds seem to be doing the opposite. And we're going to talk about the shift in CTAs as well over the next coming month and break down the fear and greed index, as well as S&P 500 seasonality. Take a look at the put to call volume ratio. But as always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the full disclaimer and we'll hop straight into it. But before we do so, if you're new to the channel, I started a completely free newsletter called Investment Intelligence, giving out free valuable finance content, as well as I try to sprinkle in some free trade ideas. This was one on Tesla going over the conditions, and that trade played out very nicely. We have SWK going over the rising wedge, giving some targets to the downside we think it could come to. That also played out very nicely. So if you're fans of free valuable content and you want free trade ideas sent to your inbox directly, go ahead and sign up for that email using the link in the description. I just started the Discord, okay, and it hasn't officially launched yet, so you can still join for free using the link in the description, and you'll be able to see all of my analysis. So you'll be able to see all of the trade ideas as well as what plays I'm in currently. Okay, these are some screenshots of the plays that I'm in currently, working very nicely here. And if you ever want to book a one-on-one session to figure out how we do these trades and make these types of returns, trading options, use the link in the description to go to my Ko-Fi page. You click on the commissions right here, and you can book a 30-minute or 1-hour session with me directly via Ko-Fi. Now, let's get into the video. And through September, a net $1.76 trillion plus of treasuries has been issued this year. That is higher than in any full year in the past decade. Now, that's excluding 2020's pandemic surge, but we're only through September, right? We're in October now, and through September, they've issued more than any in the past decade. And that's, again, just through September. We still have a whole nother quarter of the year to go. And as I mentioned before in the beginning, they're supposed to issue up to another $1 trillion worth of treasuries by the end of the year. I mean, this is just absolutely terrible news. And the bond market right now really doesn't know how to react to quantitative tightening. Okay, remember, we've had quantitative easing for such a long time where the Fed has been coming in and, buying US treasuries. Okay. And we have the complete opposite of that right now with quantitative tightening, and they're just flooding the treasury market. Okay. So, if you think that the pain is over and that it's going to be very easy and that this is the bottom, yeah, TLT may bottom here. Okay. But when you look at how much money they're flooding into the treasury market, it's really tough to say if this is actually going to be the bottom or if things can potentially go lower. The supply of treasuries continues to increase, and investors should look at bid to cover ratios for signs of weakness in demand for U.S. government bonds. So these are the bid to cover ratios. Okay, and you're looking at 2-year, 3-year, 5-year, 7-year bid to cover ratio. And so once you see weakness in this, or you can look at these, I'm sorry, rather, to actually find the signs of weakness in demand for the US government bonds. Last week we had a terrible auction, and supposedly the Fed put in a zero bid during the last week's auction on Thursday, I believe it was, and just resulted terribly for things like TLT. Now, US Treasuries are more volatile than gold, okay? And this is the first time in 45 years that you've seen this. So what we're looking at is the 7-year rolling monthly downside volatility differential between the long-term Treasuries total return and the gold return. And, I mean, guys, it's crazy. Look, this chart goes back all the way to 1980. Okay, so I don't have the data since before 1980, but since 1980, we're literally in the first time in 45 years where US Treasuries are literally more volatile than gold. US Treasuries are not supposed to be this volatile. They're already more volatile than the equity markets, right? You can just simply take a look at the MOVE, the move index versus the VIX, the volatility index. Okay, the move is the bond market volatility, and it's higher than the VIX, than the stock market volatility. I mean, we're literally living through unprecedented times when it comes to the bond market right now. I dropped a video titled "The Worst Bear Market in History," and this literally is the worst bear market in history that the bond market has ever seen. So if you want to know more about that, okay, and some of the details behind that, you can watch that video. But we're going to continue with today's video and talk about our analysis for TNX, the 10-year Treasury yield. Now we're looking for an ABC correction right here. Okay, you can see overall it's very bullish. We have these, very structured buying algorithms is what it seems to be like. Okay, and price just continuing to push up. Right, we have this algorithm right here. We have this algorithm right here, and we're really just trading in between these. And ultimately, right, we have a 1 up, 2 down, 3 up, which we're trying to determine if this is a wave 3 top. Okay, the price targets for wave 3 were anywhere from 5.1 down to 4.715. Okay, and you can see we rejected the second price target here at 4.89 very well, and I'm looking to see if this is an A down, B up, and C down, right? And this would be our correction phase for wave 4, ultimately to head back up to that 5% plus area and see where the targets can hit. Now, again, this is just an analysis projection, all right, and it doesn't have to follow to this accordingly. But ultimately, if we break above 4.89 and we do something like this, then we could experience a flat, which would still give us the ABC correction, or we could continue pushing higher, and this wave 3 may not be finished yet. But ultimately, right now, I'm tracking to see if the 10-year Treasury yield is just getting, its B wave up and is going to continue the cycle down. For a C wave, there's a gap right here, right around 4.4 for TNX to fill. So ultimately, a favorable C wave down would take us to that 4.4 area, potentially around, a little bit below and a little bit above that 4.4 on the TNX. Okay. So, if that can happen now, if we can break through this structure, all right, and break through these buying channels here, right, this nice structure, right, it's very clean. I mean, just look at the structure we have. It's very clean and organized. If we can break through that, then we'd be looking for the TNX to come back down to 4.128. That's also wave 4 territory. It can easily bounce down to 4.128 and again try to start rallying. We'll see what's going to happen. I mean, if you look at the daily MACD right here, it's very close to getting a bullish crossover. If you're going to want to see this thing go down and you're going to want to see TLT go up, you need to get a rejection here. Okay, we need to see a rejection of this and not a bullish crossover, and we need to see it continue back downwards. Now, this is TLT here. Okay, remember, basically we have our wave 3 down. This wave 4 right here was an ABCDE triangle pattern. And this was an area where a lot of people got confused and a lot of people got suckered in. Now, I had been warning about the gap down to the $95 area and telling people, hey, Don't rush into things right here. There's still this really big gap down. That gap filled, and a lot of people thought that that was going to be the bottom, and we've since continued to drop lower. So if this is our wave 4 right here, this entire triangle pattern, our wave 5 projection is going to take us down to the $80 area. That could, that's just a general area, guys. Okay, it's not live or die by. It could come down to 78. It could go up to 82. We don't know exactly where it's going to go, but this is stuff we use to help us make sense of the market's movements. Okay. And, look at all of these boxes right here, right? 1, 2, 3, 4, 5, 6, 7, 7, and then 2 new ones, 8, 9. We have 9 daily chart gaps up to fill on TLT. Now, the big thing to remember is that these gaps, they tend to fill 90% of the time. But the big question is, when do they fill, right? This gap down, this thing took almost an entire year for this gap down to fill. So we have a few gaps below $100 that we're much closer to. And we've got plenty of gaps above $100. And there is that 90% chance those gaps are going to fill. But the big question you have to ask yourself is when, right? So if you're buying TLT, you need to have a good time horizon and a good strategy and plan behind your buying. Okay. Are you buying TLT for a short-term bounce because you think the bottom is in on the bond market, or are you buying TLT as a multi-year hold and looking to play the eventual Fed rate cuts, right? A lot of people have different opinions that they're going to cut rates very soon. A lot of people have opinions that they're going to cut rates late in 2024. We can't know exactly for sure. We'll have a better understanding as time progresses. But, if you're trying to go all in times of uncertainty, when we can't predict the future and we don't know for certain what's going to happen, you at least want to have some type of plan and follow that plan accordingly and not panic sell, just because of some shorter term price action when you have a long-term thesis. Okay. Now, Americans aged 65 and up, they accounted for 22% of spending last year, which is the highest share since records began in 1972 and up 15% from 2010. And essentially what we're saying here is that the boomers and the retired group have lots of money. Okay. And while everyone is kind of worried about the economy right now, and the labor market potentially, and unemployment being something that's going to shoot up, these people are already retired and they have lots of money. And some people are wondering if this boomer group is going to be able to keep us out of the recession. Okay. And their spending actually keep the US economy driving forward. Okay, you have to remember the US is a consumer driven economy, and the consumer accounts for a very large percent of our GDP. And this group has a large percent of our spending. Okay. Again, when you take a look, they are the highest share. All right, and it's up 15% from 2010. So, it's continuing to increase, it's continuing to rise, and there's just a lot of money in this age group. Now, financial conditions have tightened the equivalent of more than 225 basis point hikes since the September FOMC, bringing the degree of tightness more in line with the Fed's intent. Now, this is something that has a lot of people saying the Fed's going to pause again. All right, is because financial conditions in the Treasury market have basically acted and tightened the financial conditions in the same equivalency of 225 basis point hikes. So if financial conditions are already tightening on their own due to the Treasury market, then it's very possible that the Fed is going to pause and, become a little bit more dovish, right? That's what a lot of people are saying right now. And that's why people are putting out charts like this, is because there's, kind of going off of a dovish Fed standpoint. Now, again, we don't know exactly what the Fed is going to do, but we can look at some data and try to come up with our best opinions. Now, the average performance of oil over the period from 150 days before and after the outbreak of conflict, if you take a look, guys, we're not here at this 50-day mark yet, right? If you look 100 days out, it seems to me like it's a very strong uptrend, okay? And so while it's going to be very volatile with ups and downs, it seems overall the first 100 days is going to be bullish for energy and for the performance of oil. So that's somewhere where you can look at for some potential opportunities. I'm not in oil right now or, energy stocks at the moment. But if you take a look, the correlation between oil prices and bond yields is mostly positive, but tends to flip in the run up to recessions. And so what this means is that, let's say if you see, the 10-year going up, then you'll see, the oil prices going up or something like that. And, that's that positive correlation. But once you start to see that negative correlation, okay, oftentimes that has led up to recessions. All right. And a lot of people are scared that, energy prices are going to start, rising rapidly and get even higher due to the whole situation in the Middle East right now. Now, we're not going to dive into the politics of anything, but that's just something that the bears are going to tell you, is that this is going to cause a recession. And this is a narrative that's going to help fuel that recession talk and the possibility of a recession. So, oil prices, they can go higher gradually, and that's fine. That won't necessarily cause a recession. But when you see the rapid increase of oil prices, creating new highs, and if it breaks above $100 and then continues going higher after there, all in a rapid fashion, that's not going to be a good look for the economy, and that could spell and spill over into a recession possibly. Now, the aggregate positioning fell further into underweight territory as both systematic and discretionary positioning dropped. That's what we're looking at right here in the market. We've seen the stock market's been falling off generally since around July, August. We've seen a nice pullback in the market. And so a lot of this makes sense. Positioning continues to decline across most sectors. There are now no sectors with meaningfully above average exposure. Okay. So basically, what we're seeing is that positioning is going down. A lot of people, we've seen a lot of selling in the market. And so it makes sense that positioning is going down here, right? I mean, wouldn't that make sense to you guys? It makes sense to me. It's just pretty much common sense. Now, CTAs have been short $47 billion of equities after selling $88 billion over the last 15 sessions. Now, this data is from last week. This is the largest U.S. short position for this cohort on record. Okay, so we've seen a significant sell-off. We're seeing massive short positions. We're seeing that sectors are, positioning is going down across sectors. What does this all mean for us? Well, asset managers and leveraged funds positioning in U.S. equities is actually elevated. So there's people out there buying the dip, right? Asset managers are buying the dip. Leveraged funds are out there buying the dip. And why might that be, right? Even if you take a look, CTAs are now set to be buyers of SPX in every single scenario over the next month. Okay. And so we just saw those massive short positions that CTAs had. All right. We saw a lot of, positioning in the sectors not looking great. But why are asset managers, leverage funds, and CTAs now buyers of the market? Well, here's some reasons. If you take a look, the fear and index greed is back at the banking crisis levels, right? This is the banking crisis, and we know that the stock market rallied pretty well after that and absorbed that banking crisis pretty well. Now we're back at those levels. We actually even went even lower than that. And, we're basically seeing lots of fear in the market. Okay. And a general rule of thumb, okay, a common saying is to buy when there's fear, right? And sell when there's greed. So you can see we're much closer to extreme fear and those extreme fear levels than we are to extreme greed. This is potentially one reason why you may see CTAs being buyers, why you may see asset managers being buyers in the market and buying the dip. Now, don't forget to sign up for that newsletter. Okay. Just want to plug that again real quick. Free trade ideas, things like that, free valuable content straight to your inbox. Okay. You can sign up for the Discord. It is completely free right now. It should be officially launched next week, and there is going to be a paywall to join in. So if you want to get in, see what plays I'm in, and get all of the trade ideas, not just, a couple from the newsletter, then go ahead and join that Discord while it's still free. And don't forget, you guys can join those coaching sessions, all right, using the commissions tab on the Ko-Fi page, where you can book a 30-minute and a 1-hour session with me. So let's go ahead and get back into why, we're seeing people buying in the market, right? We saw massive short positions. We saw, a lot of positioning going down. Why potentially is everyone going back bullish now? And why are they going to be buyers? Well, if you take a look at a simple seasonality chart, okay, this is what the seasonality is supposed to do and has done in the past. Okay. And you see that we've been following it very well, right? We make new highs, we make new highs. Then we get a pullback, we get a pullback, right? We're supposed to have a pullback. We get a pullback right around that time. Okay. Then we rally, all right. And then we get another pullback right around the same time we're supposed to. We come and hit new highs. We come and hit new highs. We hit new highs a little bit earlier this year and then got our pullback. And then we did on the seasonality. Okay. And then, we're in that period now where we're supposed to get the pullback, and the bottom lines up very well with the seasonality for the bottom. And, according to this, we should be making new highs heading into the new year, right? And this kind of suggests that we get that Santa Claus rally heading into December. And then again, we start to see another pullback, right? So we're going to see if the stock market will continue to follow this and potentially create new highs. And if it does, that's going to put the S&P 500 around that 4,600, 47, 4,800, potentially even retest those all-time highs in the stock market, ultimately before we potentially see another pullback, right? So we talked about the fear and greed index as a potential reason why we're seeing those CTAs flip to being buyers in every scenario. Now we talked about seasonality. And then when you take a look at the put to call ratio, it spiked to an extreme outside of the typical historical band. Okay. And so when you see the put to call ratio at these extremely elevated levels, what this means is that there are more downside bets. There are more puts on the market than there are call options. Okay. And oftentimes these can be contrarian indicators. Okay, look over here. When you see in March of this year, we saw lots of put options. Okay, really high put to call ratio, and then the stock market actually started to rally. So, those are basically three supporting factors as to why we're potentially seeing, asset managers and CTAs starting to become buyers in the market and buying, even though things don't look very clear right now and we've been in a downtrend. These are some of the supporting data that would basically give you guys an idea as to why they may potentially be buying. Now, we don't know if this is the data that they're looking at and the reasons they're buying, but this is some really good supporting data that I was able to find. Let me know you guys' thoughts below. Is the bottom in for TLT? Is TLT going to continue going lower? Will the stock market be able to retest all-time highs? Do you think we're going to get an end-of-year rally? Or do you think that we're basically setting up to go into a major recession and retest the S&P 500's lows right around that $3,500, $3,800 level? I'd love to hear you guys' opinion, so let me know in the comments down below. Smash the like button and subscribe for more.